Chisping, give me 3 stocks to buy right now. No kidding, 2025 is the year of opportunities to build generational wealth. Today I am sharing with you 3 stocks to buy which are not going to stop growing tomorrow or after 2 years. They have decade-long tailwinds. What's going on, investors? Hopefully guys are doing well out there. Welcome back to another video. If you are new here, my name is Andrew. I've been investing in the stock market for over 5 years and I'm sharing my learnings and experience here with you guys. Today I'm excited to share with you 3 stocks which, due to the recent market pullback, is trading near attractive valuations. Before we start, please remember, I was holding these stocks for years. I did a very solid due diligence about their financials, business model, how the heck they are making money, and all that stuff. So before you invest in these stocks, please make sure you do your own research. And now, let's begin. Our first company in the list is Amazon, which is amazing zone by financial education. 15 years ago, Walmart's revenue was 12x larger than Amazon, and today in the latest reported quarter the Amazon reported revenue higher than Walmart. Absolutely unbelievable. When you buy Amazon, you get online stores with their North America profitable segment, with their international profitable segment. Now you have robotics, you have increasing operating efficiency in the warehouses, you have autonomous delivery, so increasing the margin for e-commerce. Now recently Wall Street started to understand how bullish is this when Amazon is introducing robots, when Amazon is using autonomous delivery, when Amazon is building very efficient warehouses, optimizing efficiency on every part of the fulfillment. The margins are going to the moon, and this we already can see in the earnings report. For the other segment, which previously only AWS was profitable segment for Amazon, but right now you can see that $7 billion was printed by others. So very bullish on their online e-commerce market, and also of course advertising with Twitch, with Amazon Prime right now has also tiers for advertising, and of course AWS was the bull case for Wall Street for a long time, and right now it's still growing significantly, 19% year-over-year acceleration from previous quarter, as I mentioned, printing $10 billion in operating profit. Absolutely amazing business model for amazing zone. The growth is stellar, the margins are stellar, and AI revolution will bring a next step for growth for AWS. So this business has decades long tailwinds to grow. Many businesses will come to Google Cloud, Microsoft Azure, and of course AWS as the largest cloud provider to host all their services, to host their AI related services and AI related services as well. So actually I'm thinking about all these hyperscalers as a real estate company. They are building significant amount of capacity right now. They are investing in NVIDIA chips, they are building their own silicons, they are improving the efficiency for their cloud divisions, but they will be able to rent all this capacity for the years to come. So I definitely believe that hyperscalers will be able to take a return on invested capital which they are investing right now. As we can see from 2018, the capex investment just mooning to 2025 for Amazon, for example, from 13 billion to 100 billion dollars. Absolutely sky high number. Coming to the valuation of Amazon is currently trading as a 16 times operating cash flow, and the average for the previous 10 years is 19 times. So I believe the Amazon is cheap here. The Amazon is already trading at a discount, so Amazon is a buy right now. But if Amazon is going to 200, it would be sell your house and buy every share you potentially can. Just kidding, don't need to sell your house. But at 200, the Amazon will be a very juicy deal. I already have significant position in Amazon. For me, it's 25% of my whole portfolio. Very bullish on the margins extensions for the Amazon and about their potential growth and tailwinds for the decades to come. So for me, I am not adding at current levels, but it would be already very interesting to me, and if this thing is going to 200, I will be definitely averaging up. Analysts expect in 2027 $204 billion. If we take this $204 billion multiply by 19, which is the 10 years average for price to operating cash flow, we get $3.8 trillion company. $3.8 trillion company divided by $2.3 trillion, which Amazon is trading today, will give you 68% upside. So if 68% upside in 3 years is good enough for you, I think absolutely Amazon here, absolutely a buy. And we are coming to the second stock in our list, and this is Alphabet. Alphabet, Google, contains three most important business segments for me. This is search, YouTube, and Google Cloud. Two businesses I'm very bullish on is YouTube, which you are watching this video right now. Do not forget to click like and subscribe if you're enjoying the content, by the way. And also Google Cloud. Google Cloud is growing 30% year over year. YouTube is growing 14% year over year. The only problem I'm monitoring very carefully for the Google is their search market share. And here is the tweet you can see I posted recently, is that Google search market share slides below 90% for the first time after ChatGPT was published. When ChatGPT was published, the Google's market share was around 94%, and right now you can see it's 89%, drop under 90%. Not beautiful to see. But meanwhile, Google is just printing money, $31 billion in operating profits, $26 billion in net profits, buybacks, dividends. I think Google is a solid company. I think Google will be here to stay. It's just I'm not very sure. This $54 billion for search is very significant. This is more than 50% of total revenue. So I'm worried that if there will be significant deceleration in search advertising because of the loss in the market share, I'm afraid that Google multiple will be punished even more from Wall Street, which will have another downside for the stock. If you are buying Google, you are not only buying search, YouTube, and cloud. Google also has other bets such as Waymo. You can see this beautiful car driving yourself without any driver. You just take from point A to point B. Currently, Waymo is already operating in Phoenix, San Francisco, Los Angeles, and coming soon to Austin and Atlanta, also Miami. This is very, very bullish. I think the Wall Street is not really estimating the Waymo in their valuation model, so you basically have this as a call options when you are buying Google stock. From the perspective of valuation, the 10 years average for the price to earnings was around 24. Right now, Google is trading with the discount of around 20 times earnings. So I think the Google theoretically is a buy here. If you want some margin of safety, you can wait for Google to reach price to earnings of around 17. You see at 17 it's usually bottoming, so I think forward price to earnings of 17 is absolutely bottom. But if you are not really scared to average down, I think Google is also a buy here. The Google is printing money, buying back shares. So if we have some kind of market crash, the market was pulling back recently, if we have some kind of market crash in the future, Google will be able to buy. Currently Google is buying around $16 billion in their own stock per quarter. If we have some kind of a crash and Google will be trading under 17 times earnings, I believe Google can double this buyback and directly buying back cheap company. From the perspective of analysts is expecting Google to grow 22%, 13%, and 16% in the next 3 years. I think this is quite significant growth, and the multiple is definitely cheap for that. It's just the problem is that we are not really sure how the market share for the search will turn out. That's why the discount is there. But if you are clear about that, if you did the due diligence, if you believe that Google will be able to make their AI overview, monetize AI in different kind of ways, and finally grow their cloud, YouTube, so that they will be taking the significant market share of overall Alphabet business. In this case, I think Google is safe here, Google is cheap here, and if you believe so, I think Google is a buy here. In addition, Google is paying dividends. They started to pay dividends last year. The dividend yield is a joking 0.45%. The payout ratio is under 10, and I believe that Google will be a dividend growth machine in the future. Google has significant amount of cash in the balance sheet, so they are buying back shares, building the cloud, reinvesting into the business, and also paying dividends to shareholders. What else would you ask from the company? Absolutely beautiful. And we are coming to the third company in our list, and this is Meta Platforms. Meta Platforms is mostly advertising company, $46.8 billion coming from advertising and $1.5 billion coming from Reality Labs. Meta owns Facebook, WhatsApp, Instagram, Messengers. I mentioned most of the revenue is coming from ads. Family of apps brought from profit perspective $28.3 billion. Meanwhile, Reality Labs, which includes augmented reality, virtual reality, burned $5 billion in operating profit. Just 2 years ago, Zuck was totally obliterated by Apple by introducing the new policy for the iPhone, which forbid Facebook track the users in the third-party applications. Zuckerberg did not give up. Zuckerberg built the best recommendation algorithm in the planet, and now Family of Apps is absolutely money printing machine for that. That's why currently Wall Street is not really punishing Facebook to burn this $5 billion, because they saw that he he can prove that he can generate significant amount of cash from family of apps. So in this case, Reality of Labs is kind of a call options for you. And I really believe, because this is founder led, this is one of the founder led Magnificent Seven. So Nvidia CEO Jensen is the founder. I believe that this kind of founder-led CEOs can bring the company to next level. Jeff Bezos, Mark Zuckerberg, Jensen, absolutely unbelievable and absolutely beast of a leaders. Recently, Meta announced new developer conference LlamaCon. Due to unprecedented demand, Meta's Llama model was downloaded more than 650 million times in 2024. Meta AI reaches about 600 million average daily users by the end of the year. Following the unprecedented growth and momentum of our open source Llama collection of models and tools, we're excited to announce LlamaCon, a developer conference for 2025 that will take place April 29th. Meta says in a press release. Also, Meta is going to the robotics market. Meta Platforms is establishing a new division within its Reality Labs unit to develop AI-powered humanoid robots that can assist with physical tasks. Facebook parent Meta is entering the competitive field of humanoid robots, joining rivals such as Nvidia, Figure AI, and Tesla. The emergence of advanced AI models drives innovation in robotics and automation. From the perspective of valuation, right now the Meta is trading a little bit rich of 26 times earnings. The average for 10 years for Meta was 23 times earnings. So I believe Meta is a bit expensive here. So if you want, you can wait for the pullback to buy the Meta under this line of 23 times earnings. But for the long term, I believe Meta will be $1,500 stock in around 5 years based on my model. And I have a video on the channel when I go through deeply through the Meta's business model, latest quarterly results, and also I explained why I believe Meta will be $1,500 stock. So if you are interested in Meta, feel free to go to the description below and find the link to watch this video. From the perspective of endless expectations, endless expecting 15, 13, and 19% growth for the cash from operations. This is quite significant growth. That's why the multiple is quite expensive for Meta, and also the margins. In the latest reported quarterly results, Meta reported 43% operating margin. I repeat, 43%. It's absolutely unbelievable. So I believe that Meta deserves some kind of higher premium. But on the other hand, you need to keep in mind that if we have some kind of recession in 2026, 2027, of course the Meta as a fully advertising company will be punished first, because what businesses will cut first when they see the recession is coming? They will cut sales and marketing, and this is exactly what Meta is doing. So this need to definitely keep in mind as one of the main risks for investing into the advertising company like Meta Platforms. Meta is also paying a dividend 0.31% of dividend yield, and also payout ratio of under 9. And recently Meta announced 5% hike for their dividends. I believe that this 5% is relatively conservative. I believe what Zuckerberg is telling us is that, okay, I have many places to put money, so it's not really time for us to significantly grow the dividend and become a Pepsi company. But for me, this is totally fine. I am totally okay for Zuck to reinvest the money into the business, build the next generation glasses, build the robots, build the next generation AI platforms, and become a real leader in the new world after this AI revolution. So for me, it's totally fine. I don't really expect Meta to pay me a lot of dividends, but in 10 to 20 years, I believe that Meta will be one of the biggest dividend company in my portfolio. And that's all from my side for today. I hope you enjoyed the video. I hope you get a lot of value. Share in the comments below which companies do you believe is providing the buying opportunity right now, and I see you in the next video.